Dividend investing is often seen as the safe way to make money. Many investors believe that buying stocks with high dividends guarantees steady cash flow. But what if I told you that this popular strategy has some hidden dangers? Shocking, right? Here's a fact you probably didn't know. Almost 40% of dividend stocks fail to increase their payouts over the long term. And during the 2008 financial crisis, more than 200 companies in the S&P 500 slashed their dividends. So much for safety, huh? In this video, we'll dive into the dark side of dividend investing. From hidden fees and tax traps to the risks of relying on outdated companies, you'll learn what they don't tell you about this strategy. Stay tuned as we uncover shocking truths and show you how to avoid the most common pitfalls. By the end, you'll see that dividends aren't the golden ticket they seem to be, and how you can make smarter investment choices for the future. Ready to find out what's really going on behind the scenes? Let's get started. Chapter 1. The Dividend Dream or Dividend Trap. Dividend investing sounds like a dream. You buy some stocks, sit back, and collect checks, right? Not so fast. The truth is, there's a hidden side to this strategy that often gets ignored. Let's start with a surprising fact. Nearly 42% of the S&P 500's total returns since 1930 have come from dividends. That's impressive, but it paints an incomplete picture. Dividend stocks can lure investors into a false sense of security. Many focus solely on the yield, a percentage that shows how much a stock pays relative to its price. But chasing high yields can be dangerous. Some companies offer sky-high dividends to attract attention, only to cut them later when their finances weaken. In fact, between 2008 and 2009, over 68 companies in the S&P 500 reduced or eliminated dividends due to the financial crisis. Another common trap is overconcentration. It's tempting to load up on dividend-heavy sectors like utilities or consumer staples. But this limits diversification. A better strategy? Balance dividend payers with growth stocks or ETFs. As Warren Buffett famously said, diversification is protection against ignorance. It's also essential to research payout ratios. This number shows how much of a company's earnings are used for dividends. If the ratio is too high, say, over 70%, it could mean trouble. Companies need cash for growth, and overly generous dividends often come at the expense of reinvestment. Keep an eye on this number, and don't assume high payouts are always sustainable. Chapter 2. Hidden costs of free money. Many investors think dividends are free money. But in reality, there are hidden costs that chip away at returns. For starters, taxes can be a big hit. Dividends are typically taxed as income, meaning you could lose anywhere from 15% to 37% depending on your tax bracket. For retirees relying on dividends, this can be a rude awakening. Then there's the opportunity cost. When companies pay dividends, they're not reinvesting that money into growth or innovation. Over the past decade, companies like Amazon and Tesla, neither of which pay dividends, have outperformed many dividend stalwarts. A study by Hartford Funds found that between 1973 and 2020, dividend-paying stocks returned an average of 9.6% annually, but non-dividend payers actually delivered slightly higher returns of 10.2%. The difference? Growth potential. Fees are another sneaky cost. If you invest through dividend-focused ETFs or mutual funds, you might face higher management fees. These eat into your profits over time. Always check the expense ratio of any fund you're considering. A 1% fee might not sound like much, but it can compound into thousands of dollars over decades. So, what's the fix? Focus on total return rather than just yield. This means looking at a stock's overall performance, including price appreciation and dividends. It's a smarter way to evaluate investments without getting blinded by flashy payouts. Chapter 3. The illusion of safety. Dividend stocks often feel like a safe harbor during market storms. After all, companies that pay dividends are usually established and profitable. But this sense of safety can be misleading. Take the 2020 pandemic crash. Even reliable dividend payers like Disney and Boeing suspended payouts to preserve cash. Investors who relied on these for income were left scrambling. The problem lies in relying too heavily on dividends for stability. A report from Morningstar shows that dividend-paying stocks can be just as volatile as the broader market, especially during economic downturns. And if you're retired, that volatility can force you to sell stocks at a loss to cover living expenses. Another issue is inflation. Dividend yields often lag behind rising prices. For example, if inflation is at 4% and your dividend yield is 3%, you're losing purchasing power. This is why some experts recommend mixing dividend stocks with assets that historically outpace inflation, like real estate or growth stocks. It's also worth questioning how companies fund their payouts. In 2022, approximately 25% of U.S. dividend-paying companies used debt to maintain their payouts. This isn't sustainable in the long run and can lead to financial trouble. Always check a company's debt levels before investing. So, what's the strategy here? Diversification is key. Pair dividend-paying stocks with growth-oriented investments to create a portfolio that's both resilient and forward-looking. And don't forget to maintain a cash reserve for emergencies. This way, you won't be forced to sell when markets are down. Don't forget to subscribe. If you're enjoying this content and want more strategies to build a stronger portfolio, hit that subscribe button now. You don't want to miss the next chapter. Chapter 4. Are you funding the past? Dividend stocks often look stable and reliable, but there's a catch. Many companies prioritize payouts over progress. They focus on rewarding shareholders today instead of investing in the future. A striking example? General Electric. Once a dividend giant, GE cut its payout drastically in 2018 after years of neglecting innovation. Investors paid the price as the stock plummeted. Here's something to think about. Companies that reinvest at least 50% of their earnings into growth tend to outperform those that pay it all out as dividends. A report by McKinsey shows that businesses with higher reinvestment rates often achieve better long-term profitability. Yet, many dividend-heavy companies prioritize maintaining payouts, even at the cost of debt. This is where the concept of dividend irrelevance comes into play. Nobel laureates Franco Modigliani and Merton Miller argued that dividends don't inherently create value. What matters more is how the company uses its resources. If a business reinvests effectively, its stock price will grow, offering better returns than dividends alone. So, how can you avoid funding yesterday's winners? One way is to look at a company's return on invested capital, ROIC. This metric shows how well a company uses its earnings to generate growth. Aim for companies with a high ROIC, even if they pay lower dividends. Another tip: consider dividend growth stocks instead of high-yield stocks. Companies like Microsoft and Apple offer modest payouts but consistently increase them. Over time, this growth can outpace even the flashiest yields. Chapter 5. Dividend cuts. Silent wealth killers. One of the biggest risks in dividend investing is the dreaded cut. When a company reduces or suspends its dividend, the stock price often nosedives. A painful example? During the 2020 pandemic, Shell cut its dividend for the first time since World War II, and its share price dropped over 10% in a single day. Why do companies cut dividends? Sometimes it's due to external pressures, like economic downturns. Other times, it's poor management. Either way, the impact on investors can be devastating. A study by J.P. Morgan found that stocks with dividend cuts underperformed the market by an average of 15% in the following year. To protect yourself, pay attention to warning signs. High payout ratios, declining earnings, and rising debt levels are red flags. A payout ratio above 70% means the company is spending most of its profits on dividends, leaving little room for reinvestment or emergencies. Diversification is also crucial. Don't put all your money into a handful of high-yield stocks. Instead, spread your investments across sectors and include companies with a track record of stable or growing dividends. Look for businesses in industries that are less affected by economic swings, like healthcare or utilities. Finally, have a backup plan. Build a cash reserve or invest in low-risk assets, so you're not entirely dependent on dividends. As John Bogle, founder of Vanguard, said, "Don't look for the needle in the haystack. Just buy the haystack." In other words, focus on diversified strategies rather than chasing individual stocks. Chapter 6. Breaking free from the dividend mirage. The allure of dividends is powerful, but it's important to see the big picture. While dividends can provide income, they're not the only, or even the best, path to financial success. The key is to balance income generation with growth and flexibility. Start by thinking long-term. A study by BlackRock found that portfolios with a mix of growth and income stocks consistently outperformed pure dividend portfolios over 20 years. Why? Growth stocks often deliver higher capital appreciation, which compounds over time. Another strategy is to reinvest dividends instead of spending them. Reinvestment can amplify returns through compounding. For instance, a $10,000 investment in the S&P 500 in 1990 would have grown to $200,000 by 2020 with dividends reinvested, compared to just $120,000 without. Consider alternative income strategies, too. Real estate investment trusts, REITs, offer dividends but are also tied to property value growth. Index funds like Vanguard's Dividend Appreciation ETF focus on companies with sustainable, growing payouts, not just the highest yields. Lastly, keep an eye on valuations. Sometimes investors overpay for dividend stocks because of their income potential. Use metrics like price to earnings, P/E ratio, to ensure you're not buying overpriced stocks. A lower P/E often indicates better value. The goal is to create a portfolio that balances stability, growth, and adaptability. By combining dividend-paying stocks with growth-oriented investments, you can enjoy the best of both worlds: income today and wealth tomorrow. Don't forget to subscribe and hit the notification bell for more insights on building a smarter, stronger investment strategy. You'll want to stay tuned for the next video in our series.